Markit's flash manufacturing PMI data for March showed continuing divergences in the world's largest economies. We had a slowdown in China, whereas the US and Eurozone are enjoying their best spells of growth for around 3 years. Looking first at China, the flash PMI there recorded 48.1, falling further below the 50 neutral level, signalling a deterioration in manufacturing conditions for a third month running. Leading that downturn was a deterioration in output growth, fell at the fastest rate for a year and a half, so Chinese factories really struggling still. Looking further into those Chinese numbers, we saw that export orders rose, but overall order books weakened. Now that points to domestic demand remaining the key source of this softening of the economy. When we look at the US, the numbers there, they did dip slightly in the manufacturing sector compared to February, but the PMI is at 55.1, down from 57.1, but below those readings are signs of great resilience of output and new orders. So new orders have been growing at the fastest rate for around 4 years in February. There was a bounce back there from the weather-related weakness at the start of the year, and the fact that it's continuing to run at such a strong rate in March suggests that even after the rebound, there is good health of the US manufacturing sector. In contrast to China, the key source of demand in the US is the domestic market, export orders still remaining weak, but nevertheless continuing to grow. The underlying message of the US economy, therefore, is one of resilient growth. The first quarter as a whole, the PMI average in manufacturing there is the strongest for 3 years. Turning now to the Eurozone, like the US, the Eurozone PMI dipped slightly, but in manufacturing sector at 53.0, the PMI is remaining at a level signalling an ongoing recovery. We had some wobbles from Germany, maybe some knock-on effect of worries about gas supplies and so forth from Russia with the Ukraine crisis. The big news was a return to growth in France, where we saw the strongest reading for nearly 3 years. So the French economy is joining in the recoveries that we're seeing in the rest of the region, notably Italy, Spain, and of course Germany, where despite the slowdown perhaps linked to Ukraine, the numbers are remaining very firm. The German economy on course for an expansion of perhaps 0.7% in the first quarter, driving a Eurozone expansion of around 0.5%. French economy stabilising, of course. So a broadening upturn in the Eurozone, those manufacturing numbers joined by some firm service sector numbers, the Eurozone headline PMI covering both sectors at 53.2, down only slightly, but still signalling a good recovery. Where there are concerns in the Eurozone, it's this growth is being achieved by price discounting. So the ECB will continue to be worried that there are deflationary forces that will be hampering the outlook. Margins being squeezed. Will the ECB do more? We suspect that they will hold off. They will hold off doing more stimulus because this underlying growth momentum is there, hopefully leading to some pickup in inflationary pressures as we go forward. But these concerns will certainly be magnified by the weak price readings from the PMI surveys. In terms of policy implications for China, the government's already said it will start to bring forward some earmarked capital expenditure for the year ahead to try to boost the GDP numbers to meet the 7.5% growth target. We don't think anything more aggressive than that is in the pipeline with these weak numbers, but if they weaken further in coming months, you may see that rhetoric start to step up and more spending come through. But at the moment, we think just small measures, nothing too aggressive in China.